So I think that the secret sauce for people to succeed in the space is interoperability. We view our goal as bridging the Web 2 and the Web 3 worlds.
This is Money Code. It's a show where we decode stablecoins and programmable money so that you can better prepare for an on-chain future. I'm Chuk, Okpalugo, your host and author of Stablecoin Blueprint, and I'm here with my co-host, Parekh, head of stablecoins and payments at Monad. How are you doing?
We're live at Money 2020. This is exciting.
Live at Money 2020. We've got a great guest today. We're joined by Naveen Mallela, global co-head of Kinexys, which is a division within JPMorgan focused on digital assets. Prior to Kinexys, he held various leadership roles with JPMorgan. He's a keen enthusiast of all things digital currencies, authored white papers on CBDCs, shared ledgers, deposit tokens, and has been part of multiple industry initiatives shaping the landscape of digital money. Naveen operates at the intersection of traditional finance and emerging blockchain infrastructure. So by heading Kinexys, he's effectively driving how JPMorgan is adapting to digital assets, blockchain rails, and tokenization. So very, very significant for the future of finance. And we're really, really happy to have you here today. How are you doing today, Naveen?
Thanks for having me, Chuck. Wonderful. Delighted to be here.
It's awesome. So before we dive in, just a quick note. Money Code is brought to you by Stablecoin Media and powered by BVNK. The views and opinions of the hosts and guests are their own and may not represent their companies. Nothing we discuss today should constitute investment advice or any other form of advice. Okay. So great. Let's dive in. So Naveen, you've been thinking about blockchains and digital assets for a very, very long time, over a decade, well before most institutions. What drew you into the space originally? What's the story behind your interest in Kinexys?
Yeah, I mean, as you've said, Chuck, we've been working in this space for a decade now. While large parts of the industry were taking a wait and watch approach, we were coming at it from a lot of conviction. We were coming at it from the standpoint that distributed ledgers and tokenization has the potential to fundamentally rewire financial services. So it was that promise which led us institutionally to go big on all things blockchain since over a decade back. There have been a number of firsts that Kinexys and earlier Onyx brought into the blockchain world. Quorum, one of the leading enterprise blockchain platforms, came out of the stables of JPMorgan. The first repo product, tokenized repo product, programmable money, and now deposit tokens. So a number of firsts, all driven by deep conviction. And it's also one of those rare instances where we've not been too pressed for commercial outcomes. We were sort of given the latitude to actually just, explore, scale, and there wasn't too much expectations of commercial outcomes, which is quite unusual for JPMorgan, I should say.
Yeah. And so how would you describe kind of what Kinexys is doing today and the problems it solves and the kind of customers that you have?
The remit of Kinexys is franchise-wide. So the way we set it up as Kinexys is that we build products for the entire bank. So while I focus primarily on digital payments, tokenized deposits, programmable money, and the likes. There are other parts of Kinexys products like fund tokenization, digital financing, digital debt. So there's an entire suite of products across the lines of businesses. And again, that is driven by the fact that you need to look at, with tokenization and blockchain, by bringing in assets, cash, all of these capabilities onto shared ledgers, you create emergent capabilities, right? It's not capabilities which exist today, but capabilities which can be brought about by the confluence of all of these things.
Right.
So that's what we're most excited about.
Right. And I think from your vantage point within JPMorgan, you see such a broad swath of payments and settlements and so on. I think even before thinking about what Kinexys does, it's helpful to understand just where you see problems in payments in general, given your vantage point.
Payments have come a long way, especially if you think about domestic payments with real-time payment infrastructure, with infrastructure like Pix in Brazil, with infrastructure like UPI in India. Like domestic payments has come a long way. Where the challenges are is cross-border payments. So that is still a frontier where there is significant opportunity, and that is what we think tokenization can sort of bring about significant improvements. The last 10, 15 years, you had all of the fintechs who made a major transformation in terms of removing some of the friction or in terms of changing how the retail users interact with financial services. But at the core of it, the plumbing didn't change. A lot of the innovation was driven by pre-funding and being really smart about how you do the pre-funding and how you deploy the funds. But the core of money movement really didn't change. I will be provocative and say that since the advent of SWIFT, cross-border payments has not really changed. And that's about 50 years, right? So we do think that tokenization, the ability to bring infrastructure onto shared programmable ledgers, really can bring about the much needed transformation in wholesale money movement.
And maybe you could describe a little bit more of like the difference between how Kinexys actually evolved also. I mean, we've talked about you guys building Kinexys for almost, a decade at this point. You kind of touched on a few of the different problems. Maybe you go a level deeper, like how was the original journey of Kinexys when you guys first started, and what's been the unlock and and where we are today? Maybe just take us through that journey as well.
Yeah, we've been very deliberate in terms of our approach. The way we describe it is like the three concentric circles moving outwards. So we started with a single bank ledger. So at the very onset, what we said was, how do we introduce distributed ledgers to the bank? How do we introduce distributed bookkeeping into the bank? So in 2018, 2019, for the first time, we introduced a multi-asset, multi-cash ledger into JPMorgan. But it's still within the confines of JPMorgan. And the use cases we were trying to solve was, how can we make money movement within the JPMorgan franchise 24/7 and seamless? JPMorgan is a considerable franchise. We have a considerable footprint. Being able to just move money without cutoffs in a programmable, event-driven manner itself was very useful for our clients. So that is what we started off with in terms of a book transfer system, a cross-border book transfer system. And then from then on, the second iteration was, now how do we expand it to a multi-bank solution? So that is where we set up a separate entity, Partior. We brought multiple banks together, Deutsche Bank, Standard Chartered, DBS, all of these banks together. How do we make it a multi-bank solution? That's Partior. And then finally, now where we are is the universal ledger. Single bank ledger, multi-bank ledger, universal ledger. Universal ledger is really deposit tokens. In June, we've launched JPMD, our first institutional on-chain, public on-chain product. And that's the one which we are most excited about scaling going forward.
And maybe, you talked about some of the bank partners there, but maybe describe, why does Deutsche Bank want to work with, Kinexys and JPMorgan also? As you guys have, went from one bank ledger to a, multi-entity to now multi-partner setup, what was that journey like, and what are the motivations, and what you've seen reception from some of the partners that you guys have brought on also, where they do want to work with something that's built from JPMorgan, leverage that, given the trust and credibility you guys have also garnered over the last many years.
Yeah. So, the move towards shared ledgers requires the institutions to come together. You can't have shared ledgers without collaboration, right? And this is an unusual space for banks, right? If you look at the history of financial infrastructure, right? Go back to SWIFT, go back to Visa, go back to MasterCard, go back to CLS. All of this infrastructure were brought about by banks coming together and creating these industry infrastructure. But there hasn't been, since CLS in 2000, early 2000 or late 90s, there hasn't been really anything very similar. So it is unusual for banks to sort of come together and stand this infrastructure. It has happened in the past, but not often enough. But this time around, the move towards shared ledgers, universal ledgers, does require everybody to come together. You can't innovate in your silos. That is exactly what we are looking to move away from. So it's been also unusual for us. In Partior, for the first time, we set up an entity outside of JPMorgan, within the core payment space. We got multiple partners in. We are one of the partners on the cap table, by no means a dominant partner. So it is an unusual setup for us to sort of bring together the industry into a consortia kind of setup, think about it more like a utility and stand it up.
Right.
It goes against the very ethos of sort of what we do, but that is what is the need of the hour.
Right. But it's, like you said, it reflects back to how we've seen financial infrastructure develop in many other areas. The exchanges in the US, the clearing entities in Europe and Australia and so on, where, it starts with pain.
Yeah.
And then folks realize, hey, it's better for us all together if we create this consortium or shared JV or some other thing where the JV isn't the entity that's supposed to create its own profit. It's supposed to be distributed evenly across the parties. But then now there's a platform that you can then compete on, say the application layer and so on. And so is that how you see the progression going from, okay, each bank will realize, especially if they're global, that there's a 24/7 way to manage their own capital. Then you mentioned Partior, the kind of cross-bank ledger. And then you mentioned the third step, this universal ledger. How do we get from Partior to the universal ledger?
So this is that's a very interesting question, right? Like in many ways, we jumped from a single bank ledger to a universal ledger. We didn't think that the jump would happen so quickly, purely because of the favorable regulatory environment that we find ourselves in. There are still a number of unanswered questions in terms of like privacy, in terms of the ability to sort of have KYC and permissioning capabilities. There are a few design problems which still need to be solved for before universal ledgers can truly take off. So we do see a place in the world for shared ledgers. I think the really interesting question is going to be, we see the stack as going to fundamentally change going forward. If you think about the banking stack, all of us have some experience in the banking stack, right? Like every bank has their own channels, your payment systems, your core banking systems, your clearing gateways. In this brave new world, you're going to have shared infrastructure. You're going to have shared ledgers. You're not going to have bank-specific channels. You're going to have wallets tied to institutions and users. You're not going to have payment systems. You're going to have smart contract-driven orchestration. So the infrastructure is no longer the moat.
Right.
Now, so how do you compete in this world? Do you compete by being an issuer, by the quality of your balance sheet? Even that is coming under question with a lot of consortia thinking about consortia stablecoins, right? Like if everything is going to get mutualized,
right?
Like how are you going to differentiate? How are you going to compete? There are no easy answers around some of these things, but these are some things to be thought through. We as JPMorgan, have a view that the issuance still needs to be the preserve of institutions. So we don't think that a consortia model of issuance really scales. Okay. We think that every institution needs to have their own branded liabilities or assets to offer. But that is our point of view. There are others who think quite differently.
Right. What would you say are the key drivers of that point of view?
I mean, again, to my point earlier, we sort of feel that, at least from a JPMorgan standpoint, the thing that differentiates us is the quality of our balance sheet, the brand, the JPMorgan brand. So a JPMD, for that reason, stands at a distinct and a compelling advantage, I would argue, compared to other deposit tokens or stablecoins.
Right.
For us to mutualize that into a consortia coin, at least from our standpoint,
loses the magic.
Yeah. So loses its magic, right? Like so. Again, from that standpoint, we have a very clear thought process in terms of sort of having a JPMorgan branded liability, and all of these need to interact. Don't get me wrong, interoperability is critical. This is not about recreating the silos. There's going to be a JPMorgan issued liability, a Bank of America issued liability, a Wells issued liability. And all of these needs to interoperate with each other, whether that is through a central bank system of some sort. There are various models out there, but interoperability is critical. But interoperability does not equal consortia.
And you mentioned thinking through the different features of chains that need to occur So you mentioned privacy, and it could be resolved in a range of different ways. Interoperability. Do you see that happening on public permissionless infrastructure, or are there limitations to that you think may not get solved, and therefore the universal ledger, as you described, may need to be something that's not public and permissionless?
Yeah, that's a really interesting question. I don't know. I mean, the fact of the matter is that public permissionless at this point in time for institutional usage, there are still a few design questions out there. Can we get there? Yes. How soon? I don't know. But till that point in time, there would still be a place in the world for permissioned shared infrastructure, things like Partior. So yeah, there will be coexistence. There'll be certain use cases where universal public permissionless will give you the kind of scale, will give you the kind of network effects which is important. But for really wholesale institutional type use cases where things like privacy is important, where KYC boundaries are important, for some of those use cases, you'd still want to look at some sort of a permission chain.
Okay, awesome.
And maybe a couple of things, like maybe you can help maybe unpack JPM dollar or JPMD a little bit further as well for the audience that maybe don't know, and also maybe describe like how do you expect companies, startups, or other folks to say, hey, I actually want to work with JPMD. Like how does that work?
Yeah, JPMD is we believe a compelling alternative to stablecoins. So we are big believers in deposit-based products. Some would say self-servingly, but I mean, it comes from a very sort of deep conviction. If you look at the monetary system of today, you have different kinds of money. You have central bank money, you have commercial bank money, you have e-money, M0, M1, M2. We don't think that the structure fundamentally changes going into the world of digital currencies. We think that fractional banking, the ability to create credit, the two-tier banking system has stood the test of time. Obviously, there'll be people who debate that, but generally speaking, it has worked. It has stood the test of time. And for that reason, going forward as well, if you believe in the two-tier system, a dominant part of the two-tier system is commercial bank money. So that's why deposit-based products are important going into the world of digital currencies. So that is where, since JPM Coin, we've always innovated in terms of launching deposit-based products. So the first product, JPM Coin, was more like an account-based product. It's like putting a deposit account on chain. JPMD is putting a stable coin-like token, but which has deposit-like characteristics. Deposit-like characteristics in terms of how it looks like on the balance sheet, on the asset side, like it's not one-to-one backed. It has the ability to create credit or money multiplier, so it's fractional. It has deposit insurance. It is interest bearing. And most importantly, it has certainty in terms of financial, accounting, tax treatment. It is fungible with deposits. So for all of those reasons, we do think that it's a credible and a compelling alternative to stablecoins for institutional usage. That's JPMD. So we look forward to scaling some of these efforts.
And how do you expect, like if I'm an early stage company today, or I'm a business and I want to actually use JPMD for all the properties that you've talked about, how do I see that? Do I even see it at all? Is it very much in the back end via the universal ledger, or but how do I interact with it?
Yeah, we have, as I said, two products. JPMD is our public blockchain product, but for the longest of time, we've been, as I said, cash on chain product is our blockchain deposit accounts. So our single bank ledger, our permission chain, as we call it. So if we start from there, where we see clients getting a lot of value is the ability to move their liquidity 24/7 without cutoffs, cross-border, cross-currency. I'll give you an example of a payment service provider. Liquidity is the lifeblood of payment service providers, right? Like, I mean, with this pre-funded model, what you want to do is you want to optimize the liquidity. So if you think about like, I'll give you an example of a PSP, which has Aussie dollars in our Sydney branch, for example. You can't really extract Aussie dollars out after, let's say, 10 a.m. in the morning, but you need dollar liquidity out here in the US. So you have Aussie dollars over there, and here you're stretched on your US dollar liquidity with the possibility of running into overdrafts. So how do you solve for that, right? Like, how do you ensure that your liquidity can operate as one single whole, cross-border, cross-currency? That's what we solve for today. And that is where FX, the ability to do 24/7 FX without cutoffs, the ability to move money without cutoffs, all of that is something that has found a lot of commercial traction till date. Going forward with JPMD as well, where we think tokenization, there is a Cambrian explosion of all things tokenization, but you need on-chain cash to service all of these tokenization efforts. Stablecoins are not the singular answer for a number of reasons. As I said, whether it is the singleness of money or whether it is the pre-funded model, stablecoins is a solution, but not the solution. So that is where we think other on-chain products like JPMD will be a compelling alternative. So that's how I'd like to think about it.
How do you think about where stablecoins fall short versus where stablecoins are particularly useful in that context?
Where stablecoins fall short is, one is, again, not a day goes by without a new headline of somebody launching a stablecoin, right? Like, how this is going to clear with each other? I think the whole singleness of money question remains, right? Like, today, a JPM bank account or a JPM issued US dollar trades on par with a Bank of America issued US dollar because of the Fed backstop, because of the two-tier monetary system. You don't have that kind of a construct for stablecoin. So not yet. And even going forward, I struggle to see how that would come about. It would resemble most closely like FX markets, right? Like, so they will trade at tiny spreads to each other. So anyway, so we can debate that, but there is the singleness of money question. Mm-hmm. The second is the pre-funded model. Again, for institutional usage, so much of cross-border payments gets done on intraday credit. Mm-hmm. Pre-funded models will not work at scale. Like, if anybody's looked at this for any length of time, straight out of the gates, people will tell you, like, most institutions operate with 30% of the liquidity that is required throughout the day to service. So they start with 30% of the liquidity in terms of processing the payments. With stablecoins, you'll have to have 100% of that liquidity. So the pre-funded model is another area where it falls short. The obvious advantages are the whole peer-to-peer nature of it. Because of what they are, deposit products can't transcend the KYC boundaries as freely as a stablecoin. Every time a deposit-based product transcends a KYC boundary, there's a liability transformation. Right. You cross a JPMorgan KYC boundary, you transform from a JPMorgan liability to a Bank of America liability. A stablecoin, there is, Chuk, you and I could transact using USDC. Neither of us need to have any KYC relationship with Circle. So it does have the advantages of being peer-to-peer and reachability. So I would say that is an advantage. But yeah, I mean, I'm sure that other people will stand on other sides of the debate for this one.
Right. And I think the openness and the permissionlessness of the stablecoins being a bearer instrument give it advantages in certain areas. And I think payments is such a broad space. And oftentimes debates about payments conflate different use cases for different users in different contexts. And so I think it's really good to dissect, where certain things do better. And as you mentioned, where there is this friction from the KYC requirement, and oftentimes that could be emerging markets or kind of peer-to-peer cross-border. And I'm sure, you start at the bottom of retail and move up to SMB and the mid-market. Stablecoins may have an advantage. Then, as you were mentioning, talking about large multinationals and enterprises that already essentially have accounts with JPMorgan, and it's really managing treasury across borders and managing liquidity. Then for those institutional use cases where they really don't want to have their funds have come in from a non-KYC entity, then, having the risk management and the kind of KYC control of a tokenized deposit or tokenized deposit-like asset may be advantageous.
Yeah, I would also say that, again, we are still very early in this whole evolution of stablecoins. But increasingly, what you'll see is regulation come in. You would want you would see that different countries come in and wanting to protect the consumers or the users in their respective countries, which means that it will have to start getting regulated, right? Like you will, offshore entities will need to work with licensed entities within a particular country, licensed WASPs within a particular country to be able to distribute stable coins in any particular region. And then suddenly you start realizing, well, that is what correspondent banking is all about. Like this chains of trust. Why did correspondent banking get created in the first place? Because you create this chains of trust. But I absolutely agree with you, Chuck, that the ability to shorten these chains, especially in certain corridors, right? Like making it more peer-to-peer instead of these long hops.
Right.
I think that is definitely an area which we all need to work towards.
Yeah, and removing intermediaries, I think, is a key part of the puzzle where, I think many folks confuse what Swift does.
Yeah.
I think Swift is slow.
Yeah.
When it's just messaging, it's very fast.
Yeah.
And it's really the processes that the banks who are part of the daisy chain of a particular payment.
The ledgers are the slow ones.
Right.
Swift is just coordinating the update of the ledgers. And I think what needs to happen is these islands of ledgers need to come together into shared ledgers.
Right. It's really, that's a great way to say it. It's really about connecting islands of ledgers. And, that's what blockchains are supposed to be. That's the solution, right? Yeah. And I think you mentioned pre-funding and the ability to, how much capital do you need to support these things? And, obviously, when you're moving assets on blockchains, whether it be tokenized deposits or stablecoins, you can move that asset very, very quickly globally. And I think another element is, when building in a permissionless way or maybe on an open network, you have more folks who can provide, like you mentioned, the intraday liquidity. And so you're broadening the scope of credit providers. And there are many kind of payment financing firms who provide credit to cross-border payment companies. Obviously, banks are a large provider of revolving facilities. And so it seems like the landscape of cross-border payments is changing in order to help solve this liquidity problem and overall reduce the pre-funded balances. What other things need to be solved to really scale cross-border payments?
So, Chuk, you've hit a key point of that. I'll keep telling people, payments sometimes are slow not because of lack of infrastructure, but because of lack of liquidity. So when we go and talk to our clients about 24/7 payments, they're like, listen, you can provide 24/7 instant payments, but without instant access to liquidity, it's only partly useful. And that is where liquidity solutions, whether it is in terms of being able to tokenize collateral and use that more fungibly for cash, or creating these short-term marketplaces, liquidity marketplaces. Those are things which go hand in hand for payments. Typically, payments has been very focused on payments, and some of these liquidity solutions tended to be more capital markets. With tokenization, you start breaking some of those silos. Once you start bringing assets, collateral, money all on single chains, you start bringing, this whole world of composable finance, right? You start building all of these Lego blocks of capabilities together to solve for this problem in its entirety. I think that's what's most exciting.
So, for example, just to help break that down, would that be either payment service provider or actual business or corporation who has assets, needs liquidity, and now they have more abilities to get liquidity cheaply?
And let's take a very simple example. Absolutely that, right? Like, for example, a corporate, typically they have money market funds, they have treasuries, they have high quality liquid assets, but you want to source liquidity for 2 hours, 3 hours. You don't want to wait for collections to come in before you want to make a payment.
Right.
So the ability to tokenize some of that in a multi-asset ledger and access liquidity for a very short duration, for a very precise duration, that is transformative. Or the ability, I'm long euro, I need dollar liquidity for this particular segment of time. The ability to swap euro without having to do an outright FX transaction, the ability to use one currency as collateral and source.
Right.
What is FX swap like? But in a very short-term duration. I think those are some of the solutions which we as Kinexys have done a lot of work over the last 2-3 years. They're not thought in the same vein as payments, but these are all very critical components to bring in just-in-time liquidity. The entire edifice of cash management has been built in just-in-case liquidity. You have liquidity in multiple places, but with all of this, you move away from just-in-case to a just-in-time liquidity kind of solution.
It's really interesting because as you're talking, you can see the parallels between public blockchains versus as you call it, universal ledgers. Some of the shared principles around limit fragmentation. You want to create more a symbiotic relationship with ecosystems. There's actually a lot of shared, I think, interest and excitement around some of those principles that you laid out as well. And I guess maybe given what, even like the way you're talking about smart swaps and smart contracts, these are all things that the public blockchain sector and like the crypto space broadly thinks about as well. Like, how do you see these two worlds actually intersecting even further? I mean, if we can align on some of the principles, I think there's some debate between deposit tokens versus the singleness of money. It's stablecoins, and I think it's an ongoing debate that will continue to play out. But how do you see these worlds potentially intersecting as well? Or maybe are we always going to be in parallel roads, kind of moving in in different directions as well?
So there will be some narrow banking maximalists who believe that narrow banking is the way to go. There'll be
maybe if you can define narrow banking for the audience.
Narrow banking being like stock standard, right? Like a narrow banking, like most payment service providers, right? Like one-to-one. You're just a payments organization. You don't create credit. So in a world where there is no credit creation doesn't happen through banking system. Credit creation happens through other specialized vehicles, maybe private credit vehicles. And you move into a world where it is one-to-one, the liabilities and assets, right? Like there's a complete matching of asset liabilities. So there are some, which is the stablecoin model, right? Like $1 of stablecoins is backed with $1 of bankruptcy, remote, high-quality liquid assets. So there is that model. And then there is the two-tier model, which I spoke about. But that notwithstanding, again, there will always be horses for the courses kind of model, right? Like there will always be use cases where stablecoins will dominate, especially, at least in my mind, low value remittances in hard to reach corridors. That's a no-brainer where I think stablecoins will dominate. But on the other end of the spectrum, I will struggle to see large institutional usage of stablecoins, for example, for on-chain trading and settlement, or for large multinational corporates moving billions using stable coins. I simply struggle with that. That probably will be more the realm of tokenized deposits, deposit tokens. CBDCs or some sort of central bank equivalent, money equivalent will always be there to provide that risk-free settlement for security settlements. So we have all of these different forms of money. They will continue to exist and they'll continue to interoperate. So I don't think there is going to be a singular solution. So and I don't think these are parallel lanes either. All of them need to interoperate with each other. But my overarching point is no one product will subsume the others.
No, it makes total sense. And I think the market, as you called out, is massive. I mean, these are hyper liquid markets across multiple different dimensions that have been operating for centuries at this point as well. And they've always coexisted, to your point. And obviously over the last decade or so, with the rise of stable coins, it's now created a new economy per se that's now starting to emerge. At the same time, you guys have also, I think, done an incredible job with Kinexys and starting to say, hey, we're now going to bridge the innovation that's now possible with some of these universal ledgers as well. But maybe if you can talk about maybe your vision and maybe what comes next. I mean, a lot of the building blocks you've talked about takes years to build. I mean, these aren't just if it was just easy to build a tech and ship it like a consumer product or consumer app, then maybe we'd see a lot of these things. But to your point, there's multiple dimensions when it comes to payments. It's liquidity. It's not just the infrastructure itself. What comes next for you guys? What's Kinexys' next few years look like? So
I think that the secret sauce for people to succeed in the space is interoperability. We view our goal as bridging the Web 2 and the Web 3 worlds. we don't think that there is enough economics in pure Web3 kind of use cases, which is why the Web3 players are coming to Web2, and some of us more Web2 players are also bringing Web3 technologies to the mix. The hard part for us has been the integration. Like without interoperability, you will have massive fragmentation of liquidity, which means that some of these networks will not achieve scale. For this network to achieve scale, you need to have seamless interoperability between the new infrastructure and the current infrastructure. That is where we spent a lot of effort in terms of making our blockchain products be able to interact with the clearing systems of today. So they need to be able to talk to stablecoins. They need to be able to talk to the clearing systems or the real-time payment systems of today, and be able to manage that liquidity seamlessly. So that's been sort of our efforts, and in many different ways, I think the winners will be the ones who are able to do that bridging seamlessly. Because again, as I said, we will, while the end state is quite clear and all of us are agreed on the end state, we will be on an extended state of coexistence for some time to come.
Yeah, that's a fascinating point. I mean, there's so much to unpack. I know we're getting close on time here, but maybe we can jump into some rapid fire questions.
Yeah, awesome. I'm still thinking through the real-time liquidity creation for cross-currency asset swaps and FX swaps. My mind is racing of all the various different kind of ideas and opportunities to build in that space. So we'll have to chat about that later. But for now, let's go through some quick rapid-fire questions. The first one will be easy. Where do you see how would you define success for either Kinexys, Partior, or the Universal Ledger for the next 5 years?
For us, success would be when we become a mainstream business within JPMorgan. We are off to a very promising start, but we are still far away from being a mainstream business. In 5 years' time, if we were to achieve that, that would be a massive success for us.
How do you define mainstream business?
Mainstream business, like today, our payments business is close to a $20 billion book.
That's not mainstream.
that's what's mainstream.
Right.
Like, so we are far away from that, but we absolutely have the conviction that we can get there.
Yes, excellent. And then, what is your kind of favorite or top recommendation for content, either like a movie, books, or any other type of content?
There's so many things which come to mind, but most recently I've been reading the history of debt, 5,000 years of debt. It dispels so many notions about money. Like, so many economics books start with barter system, how money came about, and it completely dispels the myth of barter having ever existed. The earliest forms of money was credit. And it just talks about the history of credit, the history of debt. I thought that was fascinating, and it has a lot of parallels to how we think about things.
And particularly relevant for the kind of debate of credit creation.
The credit creation.
Tokenized deposits and stablecoins.
Exactly.
Right? Okay. I see you're preparing for debate there. And then finally, who else do you admire in the space that we should bring on the show? So
many individuals, right? Some of the work that the stablecoins have done, like what Circle has done, what Paxos has done, is amazing. Like, I can go on and talk about some of the shortcomings of stablecoins, but the fact of the matter is that they just generally created massive credibility for everybody working in the blockchain space. So I have huge amount of respect for some of the innovation and what they've pushed through. So yeah, I mean, would love to hear some perspectives, especially as they start going into more Web2 use cases, especially with Circle Payments Network, for example, or some of the folks from Stripe, right? Like some of the more mainstream players, how they are thinking about this. I think that would be a fascinating perspective.
We can definitely make that happen. That's awesome.
Great. Well, as we wrap up here, where can folks listening learn more about you and Kinexys?
We have a significant digital footprint. We are continuously updating that, and we are not shy of being in the media, right? Like, so you can read about us all. In fact, we are very vocal about some of the progress that we are making, not just to shine the spotlight on some of the achievements of Kinexys, but also to shine the spotlight on the possibilities on where the industry needs to be going.
Right. So mostly like Kinexys.com, like a website.
So as part of JPMorgan.com,
Okay,
we have a Kinexys landing page where we have a significant footprint of all the Kinexys offerings, as well as the most recent client testimonials and collateral.
Perfect. And what about you, Raj?
You can find me on LinkedIn at Raj Parekh and amana.xyz.
And for me, you'll find me on stableconblueprint.com, LinkedIn, Chuk Okpalugo, and on X, Chuk_XYZ. Naveen, this has been great. Thanks for joining us.
This was awesome.
Thanks for having me, folks. Fascinating conversation.
Thank you.
Thanks so much for listening to Money Code. There was so much to take away from today's conversation. I learned a lot, and I hope you did too.
If you enjoyed this episode, do us a favor, share it with someone you know, or give us a 5-star rating on Apple, Spotify, or wherever you get your podcast from. Until next time.